a lot of earnings are pretty positive. We see M&A action as well. Also a lot about this inflation story that I wanted to ask you about. This rebound in commodities that we have seen may actually help deliver what the RBA, I guess, hasn't really done the last couple of years, which is the end of this deflationary spiral. Where are you on this debate right now?
I'm quite positive on industrial commodities. There are generally two baskets of commodities: the currency commodities, which is mainly gold and silver, and they've done really well in a low interest rate environment as counter currencies to the US dollar and to paper currency. But the industrial commodities have been absolutely annihilated. Not just energy, but if you have a look at the base metals, the bulk commodities, they've come off a very high level. They've based now for a couple of years. They haven't done much, and I think the story in 2017 will be slightly different. If you have a look at a lot of the smart money managers around the world, guys like Jeremy Grantham, they've been talking about the discount in the valuation of a lot of these commodity producers. And I think as bond yields start to rise, we're already seeing that on the 10-year note from very, very low levels. When that starts to happen, I think you will also start to see a lot of these metals, like copper, for example, like iron ore and thermal coal, starting to bounce from their lows.
Yeah, you know, we see the stronger dollar, though, still quite a bit of a play here. Expectation, as you mentioned, that yields could continue to rise, inflation coming back up, particularly in the U.S. Is this the perfect case to buy the dollar, or do you see another situation, another scenario?
I think there's some great optionality here. So you can go straight into the spot market and trade the commodities themselves, or you can look for a commodity producer. You're taking equity, so there's equity risk. But some of these markets, some of these producers in very well developed economies and developed stock markets have been smashed. They're coming off a very low base. So you have a lot more leverage when you go into the equity of a commodity producer. You potentially also have some diversity. There are great diverse names out there that are across several mines, several operations, several types of commodities. And I think if you have a look at the yield trade, it's become very, very crowded. And any equity, any stock that doesn't deliver earnings growth as the yield differential changes and as these bond yields rise, any asset that isn't growing its cash flow, I think will be absolutely smashed, and there'll be a gradual shift towards the cyclicals, which are those commodity exposures.
Yeah, we are seeing those trends start to reverse into the cyclicals, Peter. You know, the call all summer has been also buying developing market equities. With the Fed rate hike, though, seems to be looming in December. Do you still think EM stocks are worth the buy? I mean, MKM saying the dollar seems to have priced in a Fed increase already. And something that we have learned since May is that EM and dollar could actually work positively. There's actually a positive relation there.
Look, I think there's two different approaches. You can take the macro view, the top-down view, and take a very well diverse exposure in an ETF or in a fund and get exposure in that way. What we like to do is take the micro view, pick the businesses that will not only benefit from the changes in capital, as you point out, but also from secular trends. If you have a look at the online space in China, for example, those tech exposures that are not only cyclical trades, but there's a very strong secular case there. They've performed very, very well. And that's our style because, you know, the larger moves, the top-down moves, you really need to have a long-term time frame. You need to be deploying large amounts of capital. You need to make sure that you're getting high-quality diversity. And I think the opportunity for the average investor, for the self-directed investor or a family office is very much taking those micro picks. And they don't necessarily have to be in emerging markets because you have a lot of businesses listed on the developed markets like the US exchange, Australia, or even in the UK, that have operations in those emerging markets.
Peter, when we teased your segment, we were talking about you being all in commodities, buying commodities. I want to go into gold because yesterday we had a guest that I was talking to who was bullish on gold. But, you know, we're talking about a strengthening dollar. We're also talking about Fed funds futures that are pricing in about a 60-ish% chance of a rate hike. That's not good for gold. What are you thinking in terms of gold by the end of this year?
I don't like gold because gold has had its rally, it's basing. There isn't really a narrative there unless you have a currency narrative. And what I prefer is a business and equity that has earnings growth potential. You know, gold gives you no yield. It's a storage of value. It's a counter currency. But if you have a look at businesses that have been using cheap debt, and we're talking about corporate debt spreads for a lot of these, you know, rising and emerging businesses that have never been this low. So there's a lot of access to cheap capital. And if you have a very good business, and if the global economy starts to pick up, you'll start to see that through the earnings growth, earnings per share growth. And I like that. That excites me more than going out and taking a currency exposure on gold, which has had its rally, it's based. There's a lot of speculation in the gold price. It's very difficult to measure the demand because, you know, there are so many different factors out there, and it's very distorted. I like to pick the individual equities themselves, and I think if you have a look through history, that's where the large amounts of wealth have been generated. In picking stocks like Google, for example, or Facebook, when, you know, post-IPO, Facebook fell. It was annihilated, and today it's one of the market darlings because it showed an ability to grow earnings consistently in a market that's growing.